Hi, everybody. It's Daniel from Just Paid. I'm here with Steve, who's our CFO at the company, and we basically are going to just have a conversation around what does a CFO do and talk about terms, pitfalls, like what works, what doesn't work. So just to start it off, Steve, what would you say for every founder out there who wants to start a company? What are probably some of the most like fundamental things to get started from your perspective?
Well, number one is a way to always monitor your cash balances, whether it's doing online linking with your bank accounts. You need a way to always know what your cash is because cash is king. You can't survive if you don't have cash. Secondarily, you need to really set up some sort of accounting system. It can be very simple. QuickBooks is kind of the de facto because you have to be able to track what's going on within your company. But those are the two most important things right out of the gate.
Okay, would you say so QuickBooks and banking, I guess you need to set up with cash. So do you recommend founders who have product market fit that don't have product market fit do a raise before they don't have product market fit, or do you recommend it after product market fit? Like, what have you seen as like the most successful and unsuccessful? Because of course you need cash. Like a lot of people self-fund it. Have you seen a lot of founders self-fund their startups and then raise?
But yeah, I've seen it. I've seen it always. Going back to your initial question, if the idea is really good, people can raise without there necessarily being the product market fit. Most investors, though, like to see some sort of a proven scenario to what it is they're trying to raise. Whether it's an idea, whether it's a product, whether it's actually a good, they like to think that the thesis has already been proven. If that answered the question.
It does. It does. And I think this is where, your CFO skills come into like play. So you're saying like they have product market fit, they start to fundraise. Generally, like founders start to go out for their Series A after product market fit. Is that correct? Or is it like the Series Seed?
It depends on what the industry is. Let's just stay within software because that's easier to put your hands around. Most of the time, they would get seed money first, even as they're scaling, even as they're figuring out their product market fit, because they need that initial money. Unless they're engineers themselves and can code everything, their first hires, they're really going to need some engineers to build the code, to build whatever the software product is they're going for. And that's usually with the seed round. Normally, when you have traction in the marketplace, kind of the line in the sand most people use is if you're getting around $1 million a year in run rate, then you go out after your Series A.
I guess another thing, maybe like a lot of people that are going to listen to this may or may not know, like what is a model? How does a model work? Do you need like a CFO or a part-time CFO to like manage that model to get that Series A? Like, first of all, what is a model? What is a CFO? Why do you need a CFO? What does a CFO do? And then like, how does that all relate to that like Series A when you have that $1 million in revenue?
Sure. What usually at a Series A, you're going to get significant amounts of money. As a line in the sand, it's usually at least 6 times what your seed was. So, let's just go back of the envelope, a basic model. Let's say you raise 3 in seed. Your A is probably going to be around 18 million, just as a kind of back of the napkin. And, that's going to be significant money. And it's a different breed of investors that invest in your A round versus your seed. An A round is usually true institutional investors that do this for a living. And one of the things they're going to want to see, yes, they look at your traction that you have $1 million in revenue. They look at what your product's doing, but they also want to see where your mindset is, where you think you're going and how you're going to get there. And that's why you end up building a forecast model, usually for the financing round, because that lets the investors kind of look under the hood and see where your thought process is. Now, why you would need a CFO, it's not just for building a model and doing the number crunching, because, very skilled FP&A people can do that, or even, you know, pretty skilled FP&A people could do that. But what you need the CFO in is to also build in the strategy and the direction with the founders of where you think you want to go. And they can really work as a bridge between the founders and the potential investors. They can kind of, and lack of a better way to describe it, they can basically translate from the founders to the potential investors. Because most of the time, a CFO knows exactly when an investor asks a question, what it is they're really looking for. So that's where having a CFO starts to become really important, is just in the communications back and forth with an investor. Have people raised an A without a CFO? Absolutely. Again, everything, it depends. It really depends on all the situations. But as a general rule, that's about the time you want a CFO coming in.
Do you want to bring in a part-time CFO, a full-time CFO? When do you recommend a part-time CFO? When do you recommend a full-time CFO?
I would say you definitely need a part-time CFO, at least going into an A round to get stuff ready. The other reason, by this point, the company is starting to mature a lot. Someone's been, at this point, I'm sure someone's already been keeping the books for the company. But as you go into diligence, you really need to make sure your T's are crossed at this point, because they're going to look to see what you've done. If you say you're doing $1 million in revenue, they're going to want to substantiate it. And that might be beyond the scope of what the person that is keeping the books is doing is able to provide. Sometimes they go as deep as doing what's called a quality of earnings report, which is like a mini audit, but it's basically just around your revenues. It's to substantiate for the investors that the revenue you say is there is really there. But we're starting to get into some complex things. And that's why I say probably you would need at least a part-time CFO at this point, because you're going to get into some things that, unless the founders are pretty financial savvy, it might be better handled by someone that's done it before.
In hiring CFOs, like what makes for the qualities you want in like that full-time or part-time person? Like what have you seen as like the most successful CFOs, and like what's the worst behavior from a CFO that like you shouldn't hire that person?
I'll go from the worst first. The worst behavior is if a CFO wants to work in a silo, doesn't want to share anything, doesn't want to try to collaborate and educate the founders when necessary. That's the worst, because, you need to be a team, and investors can see through that. Investors can see if the founders and the CFO aren't on the same page, and they probably won't invest if they sense that. But really, the best CFOs are ones that can collaborate. I call them, they're chameleons. They can work up and down. They can talk the talk with the investors, but they can also help the founders, because here in the Valley, a lot of founders are first-time founders, and they're really going out of their skill set. A lot of financial stuff is way out of a founder's skill set. Most founders tend to be technology-based. A good CFO is going to help educate the founders as you go along, so that they understand what's going on. The worst thing to do is just, as and this is to the founders, you don't just hand everything over to your CFO and let them run. You need to be involved with it. Now, do you need to micromanage? No, but a good CFO is going to keep you up to date and try to educate you as you go along. And you should ask the CFO if you don't understand something, especially when you start down the investment track. If you don't understand terms of the investment, you need to ask your CFO, because the last thing you want to do is give away more of the company than you want, or get really bad terms in your investment that hurt you later. We don't want to go down that rabbit hole, because that's a whole nother conversation. But there's things in the investment, even in an A, there's preference rights. that can affect later rounds. So you want to be very careful of what's embedded within your A round.
I see. So the CFO will also help with understanding dilution over time for
Yeah.
the.
Yes, the CFO can help with that. And also fish out any terms. For instance, if an investor comes in and wants to get what's called 2 times preference rights, that's really going to mess up if you go out to do your Series B, because they're basically going to have twice the rights as your B, which you don't, that creates a tough financing stack. You also, again, this is out of the CFO's scope, really. Really, if you're doing a material Series A, you really need good legal involved also, because your legal and your CFO kind of check and balance each other and make sure that the terms of the round are going to be beneficial to the company.
Got it. You hire the CFO, you hire someone that you work well with. For founders who are successfully hit that $1 million mark and they hire that CFO, what would be the cadence of working with them, like working on modeling? And modeling, I get, it's projecting out like revenue and burn rate and all of that. Like, what is the cadence there? Is it a 1 month cadence? Is it like every quarter? And like, what are the expectations that you've seen for the most successful companies that you've worked with? Like,
You should review your forecast model at least once a month when you review your actual financials. Your financials that have happened, they're like a scorecard. That's letting everyone know what you did and how you did. Your forecast, you always should be updating it at least monthly, because that kind of gives you guidance where you're going to go. And it tells you, are you going to get there based on what you think? And that's why it always needs to be revised. No one can forecast their sales that accurately, especially when you go out a year. If people can, they have a secret no one knows. But that's why it becomes important, because you really have to feel confident that things are going to happen at least within the year short term, because you're going to base a lot of your decisions on what you think are going to happen from your sales side, whether you can fund your growth. And also, if it doesn't happen, are you comfortable with growing without the revenue being there, living off of the funding you've already had? So it's kind of a balancing act. And that's why it becomes important, because it really builds your strategic decisions on where you're going, both short term and long term.
And I guess keeping the investors updated, like from Series A, seed, and Series B, like as you go through this process, do you meet with your investors more? Do you keep your seed investors updated? Like what, information rights are a thing for some investors and they're not for others. Like what have you seen as like the most successful relationship with investors?
The best thing to do is you send out at least a quarterly blurb to all your investors. This is where we are. This is how it's going. Now, your lead investors are likely going to be on your board. So they're going to be in the know of everything anyway, because they're going to be at your board meetings.
Are there any metrics that you say are like, let's focus on software companies. Like what are the basic metrics every founder should know? The CFO should know what's presented normally. Like you have very specific metrics that you always like build out. Is there any like top 10 or so metrics?
Yeah. Oh yeah. It would be, what's your current recurring revenue? What's your churn rate? What is your burn rate? What is your current revenue run rate? I look at other things. I like to look at the working capital monthly. I like to look at net revenue retention. I think is a good one to look at. And these are all, a lot of the other KPIs are offshoots from, these kind of basic ones. I also look at, a lot of accounting KPIs, but, those don't necessarily need to be educated through the founders. Those are more checks and balances on your financial health. You have all kinds of ratios you can look at to see. You can common size your financials to see. Common sizing, you're looking at what percentage of your revenue you're spending in different buckets. For instance, if you're a technology company and you're spending 80% of your revenue on your sales, if you don't have a lot of sales, that's probably not what you should be doing, especially if you're building product. The majority of your spend should be in your R&D. That's just an example. So
Got
there
it.
are a lot of things to look at. It really is business model specific, what KPIs are the best fit.
Got it. So for some of this, it doesn't sound like it's like gap reporting, right? You're doing like
No.
well, and what is gap reporting versus like what you present to the investor?
Well, the investor definitely gets gap reporting, shall we say, because technically you want to keep your books in accordance with gap. So, going back to my earlier conversation, the scorecard you give out, which is the financials that have already happened, those should be in accordance to gap. And it's really important to stay in accordance to gap, because when you go to do any sort of financing or exit, when the acquirer or the investor is looking at your financials, if you haven't had an audit, they probably will do one. And if you haven't been in compliance with gap, that can wildly swing what you say the results were versus what they really are. So it's always important. And I also recommend, by the time you're at an A round or have closed an A round, you should probably go in a cadence of getting an annual audit anyway. It's a really good safe harbor.
Got it. And an
Now
audit.
you don't necessarily have to go out and get a top tier firm to do it. Especially here in Silicon Valley, no one goes out and gets the big four for a little company. Number one, they're too expensive, and number two, they don't have the time. But if you get someone that's still reputable, there's a lot of tier two national firms that can do your audit. Audits are not cheap, but it's a really good safe harbor for the company.
And how long does an audit take? Like a week, a month? I guess it depends on the firm.
Yeah, and it depends if you've ever had one. Once you've already had one, if the accounting group is keeping the books in pretty good order and the documentation is really good, you can get through an audit in probably 3 weeks from start to, for the actual field work. Now, there's some other things that go on, but, an audit in general shouldn't take a real long time.
I guess, is it always required from investors, or would you say that that's
It is sometimes. There's things within the, we'll go back to the Series A. There's things sometimes in the financing, it's called covenants, that you have to meet. And sometimes an annual audit is a covenant that an investor puts in.
so it's a requirement? A covenant is a requirement.
Yes.
Okay. Knowing all of your history, like what would you say is a run rate that is worrisome, and what's a run rate where you feel like that's too long? Like what would you say is like the average, like good run rate for a company, and then when should they go out and do like their next funding round?
A good run rate's at least 18 months. When you fall below 18 months, you need to scramble, because rounds are usually not quick. As a given rule, from the time you decide to raise a round till the close is likely going to take you 6 to 8 months if you're fast. It could even take you up to a year. So if you're running under a year's run rate, you're probably in trouble.
Got it. So when you do a funding round, you should have what, 2 years in the bank, 3 years in the bank? Like say it's a successful fundraise, you get so much.
Yeah, you would want at least 18 months in the
Okay.
bank. At
Okay.
least 18 months. Now, where that becomes complicated is if the company starts getting revenue traction, then it might be less burdensome. If it looks like they're going to grow at a real exponential rate, then it's not as worrisome because you have cash coming in to take care of yourself. Because when you look at your run rate, you're basically freezing everything. You're freezing anything coming in, and you're freezing your spend, and you're seeing how long you'll survive at that, with those two freezes. But if you do have substantial revenue coming in, that changes the equation. Then you have to be conscious of what you have going out.
What do you mean by that? Like what you're spending on?
Exactly. Just because you have a bunch of revenue coming in suddenly, does that mean you should still stay to your plan, your hiring plan, for instance, because that's usually your most expensive resource? That's your greatest spend. Or does it make sense to kind of wait and see on their milestones to keep hiring? Like, for instance, again, if you're a technology company, do you wait until the next version of the product comes in and you hire more and see what the traction is? Or do you keep building and then worrying? Or, if you're showing really good revenue, do you need to hire more salespeople to get even more? Will that be productive? So, that again, going full circle, that comes back to why it's important to review your forecast, your model all the time, because you have these different levers you can pull. And that's why it's important for not just the CFO and the founders, but, later on, the executive team, you all have to be on the same page. It should be an open discussion. And that's how you that it's kind of a starting point for these discussions on what direction you want to go.
Got
Because,
it.
there's always if you go in one direction, there's always a downside of not going in a different direction. So that's what you need to discuss.
Got it. So you're saying here's all this revenue. We have a long run rate it's a long run rate. So you want to take that investment and put it someplace. You have that conversation to say, hey, do we hire more people? Do we build this software?
Yeah. Do we want to hire more salespeople? Do we want to hire more engineers? What do we want to do? Do we want to create a new product, to add to our portfolio? So then you would want to hire more engineers. So it becomes a collaborative discussion, the direction you want to go.
Have you seen a lot of venture-backed companies peel back from that burn and just kind of keeping a war chest, or that's rare?
It's not rare. Sometimes, ironically, people peel back going into a financing round because depending on the economy, when the economy is really good, investors like to see growth. They're not really caring about either cash flow positive or EBITDA positive. They're more concerned with growth. But when an economy is bad, they start getting concerned with, do you have a path to break even? So, it really just depends on what the market is doing at the time.
And if you have a path to break even and you go that path to break even, does that mean the company, I guess, it doesn't speed up more? Maybe it just stagnates. Have you seen that? Like,
It stagnates, but it also again, it depends on the company. I worked for a company several years back that ironically never took funding. It self-generated itself and it grew exponentially.
wow.
It actually grew past the $30 million a year company without any investment, and it was highly profitable. That's not the norm, but it can happen.
Right. On the finance team, the CFO is there, like these other executives come in as you're making all of this money. Like, what is the function of the CFO versus the other executives to help them? Like, what's the best CFO? You said don't work in a silo as a CFO. Like, what's the best cadence for that CFO to work with like all the founders and the salespeople and the other team members and the engineering team? Like, what have you
Oh, it
seen?
should be, the other execs, they should be working at least weekly together on everything to make sure they're all on the same page. And everyone, it's not just the CFO, like the head of engineering, the head of revenue, they all have to be strategically sound on they're going in the same direction. If sales thinks you're going in one direction and engineering thinks you're going in a different, that is not going to bode well down the road. So you really need to all have the same strategy and be in tune. And that's why it's really important to meet all the time. And again, I don't believe in the CFO sharing, how could I say it, confidential data to everyone, but definitely to the stakeholders. Everyone needs to be informed because that helps everyone make a decision. Because, I have found over my years that, a lot of people they're much more financial savvy than they let on. And if you give them the right data inputs, they can help make decisions. I've seen and several companies that have been very strategically aligned and collaborative, where you put the things out there and the head of revenue might say, you know what? To me, it's more important that we build this feature set into the product than for me to have more salespeople. So I'd rather have us spend the money to build this feature set out because it will benefit me later. Then I'll hire more salespeople. See, that's a collaborative team.
I see.
If the head of revenue just says, no, I need more salespeople, that's you need to collaborate. And that in all the companies I've been in, the ones that have been successful and come to an exit, they've been able to collaborate that way. It's not always that way at the beginning, but they eventually get there.
Is it the role of the CFO to create that collaboration, or is it the role of the CEO or the COO or some other executive, or all just?
I think everyone has to work together. I think the CFO can help bridge the gaps because they can start a lot of the conversations and they can, help facilitate some of the things because they have a lot more data than the other people have usually.
Got it.
And that's where it becomes important. That's where they shouldn't silo themselves. They really need to share the data across, especially the executive team, so that everyone can make good, collaborative, informed decisions.
Got it. I know we're running out of time. One more question for you. Like what do CFOs normally like share like financially with like the whole organization? Is it like
With the whole company?
Yeah.
I think it's fine to share, where your revenue is, maybe where I wouldn't say sometimes it's okay to share run rate. It's okay to say you don't have to give details, but it's okay to say if you're break even or not. Because most people are sophisticated enough now to know most companies don't hit break even right away. It takes a while. That's okay to share. I probably wouldn't share a cash balance necessarily. That's more of a confidential thing. Run rate's more confidential. But going back to some of the KPIs you were discussing earlier, those could be shared. I think it's really good for everyone to know what your recurring revenue is, what your churn percentage is. Things like that are perfectly fine to share across the company.
Okay, awesome. Well, this was amazing, Steve. I guess anything else, any parting words for everyone that learned about like what a CFO is?
No, other than well, I guess yeah, my parting words would be collaboration is key.
Cool. Awesome. Well, thank you so much, Steve. This was awesome.
Certainly. I enjoyed it.